Here is something that nobody in the financial system wants you to understand. Being broke is not free. Being broke costs money. Real money, significant money, every single year. The financial system is designed in a way that charges people with less money more for almost everything. The overdraft fees, the predatory interest rates, the small quantity grocery prices, the higher insurance premiums. The average American living paycheck to paycheck pays approximately $3,000 to $5,000 more per year for the same life that a financially stable person pays less for. $3,000 to $5,000 every year. That is money that could have been building wealth. Instead, it is being extracted from the people who can least afford it by a system they were never taught to understand. Today, I am going to show you the exact math. And then, I am going to show you the exact sequence that breaks the cycle. Because the poverty premium only works if you do not see it. Once you see it, you can start to dismantle it. Stay with me. Let us start with a number. The average overdraft fee charged by American banks in 2025 is $35. That sounds like a one-time inconvenience. But here is what it actually looks like in the life of someone living paycheck to paycheck. When you have almost no money in your account and an automatic payment goes through at the wrong time, a subscription renewal, a utility payment, a car insurance premium, your bank charges you $35 for the privilege of not having enough money. The payment itself might be for $40. You pay $40 for the payment and $35 for being broke. That is a $75 transaction for a $40 bill. An effective interest rate on that $35 fee calculated over the typical 2-week period before your next paycheck is approximately 900% annualized. 900% for the crime of having too little money at the wrong moment. And this is just the beginning of the banking component of the poverty premium. Banks in the United States generated $17.8 billion in overdraft and non-sufficient funds fees in 2022 alone. $17.8 billion. The vast majority of it paid by the people with the least money in their accounts. People with high balances never experience this fee. Their buffer protects them automatically. The fee is structurally designed to fall on the people least able to absorb it, but overdraft fees are just the first layer. Let us talk about interest rates, because this is where the poverty premium becomes genuinely mathematical in its brutality. When you have a good credit score, which requires having money and managing it well over time, you get access to credit at low interest rates. A mortgage at 6%, a car loan at 5%, a personal loan at 8%. When you have a poor credit score, which is the predictable result of not having money and occasionally missing payments because of cash flow problems, you get access to credit at high interest rates. A subprime car loan at 18 to 24%. A payday loan at 300 to 400% annualized. A credit card at 29.99%. The credit score system is presented as a measure of financial responsibility. What it actually measures in large part is how long you have had money and how consistently you have not had cash flow emergencies. Which means it tends to reward the financially stable for being financially stable and punish the financially struggling for being financially struggling. The same $1,000 borrowed costs a financially stable person $80 a year in interest. It costs a financially struggling person $299 a year in interest, 3.7 times more, for the same $1,000. The system charges you more for credit precisely when you most need affordable credit, and less for credit precisely when you need it least. Now let us talk about groceries, because this is the component of the poverty premium that affects people the most frequently and the most invisibly. Buying in bulk is cheaper per unit. This is an economic fact that everyone knows. A 32-ounce jar of pasta sauce is cheaper per ounce than a 16-ounce jar. A 12-pack of paper towels is cheaper per roll than a 4-pack. The family-sized box of cereal is cheaper per serving than the small box. This is obvious. But here is what requires money to access: the upfront cost. If you have $50 for groceries this week, you cannot buy the $30 bulk pack, even though it is cheaper per unit because you need $40 worth of immediate food to eat this week. So you buy the small quantities at the higher per unit prices. And you do this every week. And over the course of a year, the cumulative price premium for buying small rather than bulk adds up to between $800 and $1,200 annually for the average household. There is a second grocery component to the poverty premium that is geographic. Areas with lower average incomes, the neighborhoods where people with less money tend to live because of housing costs, statistically have fewer full service grocery stores and more convenience stores and dollar stores where the prices are higher for a more limited selection. Research from the USDA consistently finds that low income neighborhoods have grocery prices that run 8 to 12% higher than higher income neighborhoods for comparable items. You are paying more for less convenient access with fewer options. The poverty premium on groceries alone is real, documented, and significant. Now let us talk about insurance because this one surprises people the most. Car insurance premiums are calculated using a model that correlates insurance risk with, among other factors, credit score, zip code, and home ownership status. People with poor credit scores pay significantly higher car insurance premiums than people with good credit scores for the same car, the same driving record, and the same coverage. The average difference in annual car insurance premium between a driver with excellent credit and a driver with poor credit for identical coverage is approximately $1,000 to $1,500 per year. You are paying more to insure the same car because you have less money. The insurance company is charging you for being in a financial situation that correlates statistically with higher claim rates. Whether that correlation is fair or not is a separate debate. The mathematical reality is that poor credit costs you $1,000 more per year in car insurance alone. Health insurance tells a similar story through a different mechanism. People employed at large companies with robust benefits programs get heavily subsidized health insurance. The employer pays the majority of the premium, and the employee pays a fraction. People who are self-employed, work part-time, or work for small businesses without benefits buy health insurance on the open market and pay the full premium. The full premium for an individual in 2025 averages approximately $500 to $600 per month on the marketplace. $6,000 to $7,200 per year for the same coverage that a corporate employee gets for perhaps $100 to $200 per month of personal contribution. The access to subsidized insurance correlates strongly with the financial stability of your employment situation, which means the more financially precarious your situation, the more you pay for health coverage. Let us now total the poverty premium with real numbers overdraft fees. Average for someone who experiences overdrafts regularly, $400 to $600 per year. Interest rate penalty on borrowed money. The extra cost versus what a good credit score would produce, $500 to $2,000 per year depending on debt level. Grocery price premium, small quantity buying plus geographic premium, $800 to $1,200 per year. Car insurance credit score penalty, $1,000 to $1,500 per year. Health insurance premium gap for unsubsidized coverage, $3,000 to $5,000 per year if applicable. Total poverty premium for a household experiencing all of these factors, between $6,000 and $10,000 per year. $6,000 to $10,000 extracted annually by the structural financial system from the people who can least afford it. That is the math of being broke. Not metaphorical, not approximate, documented, researched, and real. Now I want to show you why this creates a self-reinforcing trap that is genuinely difficult to escape without understanding the mechanism. The poverty premium consumes money that could theoretically be used to build a financial buffer. But there is no financial buffer because the money is consumed by the poverty premium, which means the overdraft fees continue, the high interest rates continue, the small quantity grocery shopping continues, the buffer never forms, and the poverty premium never stops. The person trying to save is trying to fill a bucket that has a leak. The leak is the poverty premium, and the only way to close the leak is to get ahead of it to build a buffer large enough that the overdraft fees stop, the credit score improves, the insurance premium drops, and the bulk buying becomes possible. But building that buffer requires money, and the poverty premium is consuming the money that would build the buffer. This is the trap. It is circular, it is mechanical, and it is not a personal failure. It is a mathematical problem with a mathematical solution. Let me show you the sequence that breaks the trap. The sequence has 4 specific moves designed to close the leaks in the right order. Move 1. Close the overdraft leak first. This is the most immediately actionable and the most expensive per dollar leak in the system. You close it by doing 2 things. First, you switch to a bank that does not charge overdraft fees. Banks like Chime, Current, and Ally Bank have eliminated overdraft fees or offer significant overdraft protection without charges. This switch costs nothing and saves you immediately. Second, but you build a micro buffer in your checking account, not a savings buffer. A checking account buffer, a consistent balance of $100 to $200 that never gets spent, that exists solely to prevent your balance from ever hitting zero. Even $100 sitting permanently in your checking account eliminates the overdraft fee risk completely. This is your first priority because it stops the most expensive leak per dollar immediately. Move 2. Attack your credit score intentionally. Because your credit score determines your interest rates and your insurance premiums simultaneously. Improving it has a multiplied effect on the poverty premium. The fastest legal ways to improve your credit score starting from a low point are: first, pay every bill on time starting immediately, including minimum payments on existing debt, because payment history is 35% of your credit score, and the impact of consistent on-time payments begins showing within 3 to 6 months. Second, reduce your credit utilization ratio by paying down balances below 30% of your credit limit. If you have a $1,000 credit limit and $500 on the card, you are at 50% utilization, which actively damages your score. Getting below $300 on that card moves you to 30% and produces a measurable score improvement typically within 1 to 2 billing cycles. Third, do not close old credit accounts even if you are not using them. Account age is a factor in your score, and closing an old account reduces your average account age and can drop your score. Move 3. Build the bulk buying buffer. Once the checking account micro buffer is in place and the overdraft fees have stopped, the next target is a $200 grocery buffer. $200 held specifically to enable bulk buying when prices are favorable. This is the fund that lets you buy the 30-pack of paper towels instead of the 4-pack, the large pasta sauce instead of the small one, the family size instead of the individual size. You use it. You replenish it. Over the course of a year, the grocery premium drops by hundreds of dollars compared to week-by-week small quantity buying. Move 4. The emergency buffer and credit score improvement compound together. As your credit score improves from the on-time payment history and reduced utilization, your car insurance premium will begin to drop at your next renewal. This is automatic. Insurers re-rate policies at renewal, and a meaningfully improved credit score produces a measurably lower premium at renewal time. The money freed up from the lower insurance premium goes to the emergency savings buffer. As the emergency buffer grows, your credit score continues improving because you are not missing payments due to cash flow emergencies. As the credit score continues improving your interest rates on any new borrowing drop. As the interest rates drop, more of your debt payment goes to principal instead of interest. As principal reduces faster, your debt balance drops faster, which improves your credit score faster, which reduces your insurance further. The exit from the poverty premium is a positive feedback loop that mirrors the negative feedback loop of the trap itself. The trap is mathematical. The exit is also mathematical. The difference is knowing which leaks to close first. Overdraft fees first, credit score second, bulk buying buffer third. Let the positive loop run automatically from there. $3,000 to $10,000 per year that is currently being extracted from you by the poverty premium begins to close. The money stays in your household instead of being extracted by the financial system. The buffer builds, the loop turns positive, and the mathematics that was working against you begins working for you instead. This is not a motivational message, it is arithmetic. And arithmetic does not care about your feelings or your circumstances. It runs the same way for everyone who understands it and applies it in the right sequence. Subscribe because next week we are covering something that builds directly on this. 10 specific financial mistakes that are quietly keeping people poor. Not dramatic, catastrophic decisions, but the ordinary daily ones that drain wealth invisibly until one day you realize the decade is gone and the account is empty. Share this video with someone who is living paycheck to paycheck and wondering why saving feels impossible, because the answer is in this video, and knowing the answer is how you start to change it. See you then.